So I think you may remember, just briefly I explained some that concept of the cost of capital. So I think you can see my PowerPoint. So basically you learn that importance of the cost of capital and the role financial manager should play in estimating the cost of capital. So therefore, you know what is cost of capital. That is very important number, important figure in a company or in a business in making especially investment decision. So without knowing this number, it is very difficult to take a decisions, because that investment rate of return we have to compare with the cost of capital. So therefore, without knowing that number, financial manager may face very difficulty in playing his or her role. So cost of capital, I think we can define in different way. Actually, that is the minimum required rate of return for the company to earn from their investment. So it is the cost of capital of overall sources of funds. So that's consider the cost of each component, and then we estimate the overall cost of capital. So sometimes you can see the synonyms, like we call in time value of money. You remember that we discounted expected cash flow using discount rate. That discount rate especially is reflect this cost of capital. So in security valuation, we use this cost of capital as the investor's required rate of return. In bond valuation, in stock valuation, in ordinary share valuation, you use that is as a required rate of return of the investors. Now this is from the company point of view. Now we are going to estimate that number. This is we call cost of capital or cost of capital of the project or company. We call weighted average cost of capital sometimes. This reflect the marginal cost of capital, because that is really that number should when we raise in 1 rupee of say one rupee, it should reflect the relevant cost of capital. So therefore, some textbooks you can see we term it as a marginal cost of capital. That is the cost in raising additional 1 rupee. So related to the investment, you should know what is the marginal cost of capital. So different terms we are using, but with the same meaning, right? So those are the sources of financing. I think we discussed these things last week, and also the relationship between the risk, required rate of return, and the order of the each sources on the based on the risk. I think we discussed. Now we are on here. How to estimate the overall cost of capital. Now, in order to estimate the overall cost of capital, you should know cost of debt. Here, RD is the marginal cost of debt, that is before tax. RP, that is marginal cost of preferred stock. RS is cost of equity, that is also marginal cost of equity. This can be RS or RE, because if you are using internal equity or retained earnings, the term that we are using is RS. But if you are raising ordinary equity by issuing new share, so that is we call external equity. So then the term using here RE, R substitute E. So therefore this RS or RE reflect the marginal cost of common stock, either internal or external. So if you know this cost of each component, and also if you know the weights or the investment or the fund raised using each source, that is we call weight, cost of debt, its weight, and also cost of preference shares and its weight. Say in the capital structure, this is capital structure. In the capital structure, there will be cost of equity, say cost of equity, internal equity, cost of here ROK we can use. I have written here K because that also we are using very frequently. Anyway, if for the consistency, I will use the same term here. This is RS, cost of internal equity. This is RP, cost of preference shares. RD, this is cost of equity. And also you should know the weight on each type of funds. Say equity capital, say 60%. From the total asset, you have raised, you have used equity fund to raise the 60% of the total asset. So that is the its way. Say cost of preference and the equity and the weight on the preference stock, say 40%. No, 40, say 30%. Then balance from the debt capital. This is 10%. So likewise, if you know the cost of each component and also if you know the weights, that is right. So that is from the total asset, how much you have financed using the equity capital. It is its way. From total assets, how much you have financed from using the preference shares. That is its weight. From total asset, how you should finance or how you have financed with the debt, maybe debentures, bonds, or the long-term debt. So likewise. So when we say the, now if you look at this, the RD before tax marginal cost of debt. Marginal cost of debt means that is actually the very relevant number. Cost of capital you can calculate using past historical value, or we call embedded number, or you can calculate based on the target capital structure that is expected to be in future. Here, that marginal cost of capital mean actually this is the cost that you have to incur if you are raising 1 rupee of debt. එක රුපියලකින් debt capital එක වැඩි කරන්න ගියොත් මේ තමයි ඔයාලට දරන්න වෙන cost එක. So that's what we call marginal cost of capital. This cost of capital number you can calculate based on the past weight or the past or the existing capital structure also. But the very useful one, and also mostly we have to look at in the investment analysis, the one we have to look, that is marginal cost of capital. Not the historical cost of capital, not the current cost of capital. That is relevant to the future. When you are raising debt capital, when you are raising equity capital, when you are raising preference shares, what is the cost you have to bear? So that show in the marginal cost of capital. So that is the difference. Sometimes we term, actually in some textbooks, in general, we term it as a cost of capital. This cost of capital reflect marginal cost of capital. Then marginal cost of preferred stock mean that is the cost that you have to bear when you raise 1 rupee of preference share, one rupee of preferred stock capital. Cost of marginal cost of common stock mean that is the cost that you have to bear if you are raising 1 rupee of ordinary share capital. So likewise, that is relevant to the future. So therefore, that is very relevant when you are analyzing, when you are assessing investment. Because today we are selecting investment. For these investments, you need some money, funds. So you have to raise funds. So if you are going to raise funds, say using bank loan, or maybe using debt, debentures. So this is the applicable rate. This is the applicable rate. So that is the marginal cost of debt. I think that's clear. So if you know these numbers, cost of debt, after tax cost of debt and its weight, cost of preference shares and its weight, cost of equity and its weight, then using this formula, you can calculate overall cost of capital, or we call weighted average cost of capital. That means that is weighted average cost of capital. So in order to compute WACC, weighted average cost of capital, before you should know what is the component cost of capital as well as weights on each type of capital. So if you know these numbers, just simply you can apply this weighted average cost of capital. So now here you can see only that this tax adjustment we have done only to the cost of debt. Now here related to the cost of preferred stock, no any tax adjustment. The required rate of return of the investor simply is the company's cost of preferred stock. No any tax adjustment required. And also from the here for the cost of equity, no tax adjustment. But here you can see for the cost of debt, there is a tax adjustment. Right? This RD here, see the definition here, before tax marginal cost of debt. Before tax marginal cost of debt. On the debt capital, company earned some tax savings. Company receiving some tax shield. So therefore, the real or the true cost of debt is not the interest rate that you are paying to the bank, or it's not the YTM on the bonds, but that number should adjusted for the tax shield or the tax savings, because that interest is tax deductible expense. When you are preparing the income statement, that interest or financing cost, you can deduct before computing the tax. It's a deductible expense. So therefore, because it is a deductible expense, so on this interest, on this coupon or in this interest, you are gaining some tax saving. You are gaining some tax shield. So therefore, when you calculate the real cost of debt or true cost of debt, this before tax cost of debt, you have to adjust for tax shield or tax savings. So that is applicable only to the debt capital. But for the equity capital or for the preference share capital, it's not applicable. Why? Why? That preferred stock dividends we are paying after the tax. We are paying on the net income. So when you compute the net income, tax is almost deducted. And also for the ordinary shareholders, they are receiving their dividends on the net income after deducting all the expenses. So therefore, for this cost, for the preferred stock cost and also for the equity stock cost, no need to adjustment for the tax. But here we have to do that. Right, I think you can understand further. I am elaborating this point. Now, if you, before that, how are the weights determined? Weights. This is weight on the debt capital, weight on the preference shares capital, weight on the equity capital. How we determine the weights? Are we based on past data or the historical value or market value? Normally, these weights we calculate using the market value, not based on the book value. And also this weight, if it is very rational, to have a very rational cost of capital number, the actual number or optimal capital structure weights you can use. So there are some different views on this weights calculating, but anyway, when you determine the weights, you have to base on the market value of each capital. Market value of the equity capital, market value of the debt capital, market value of the preference share capital. And also you can determine weights based on the target capital structure or the optimal capital structure. The target capital structure is the one that we are expected to be in future. So that target capital structure can be the optimal one. That can be the optimal one. So weights you can determine based on target capital structure or weights, but don't determine based on the book value or historical value, because they are past. So that number is not realistic if you are calculating weights based on the book value. So therefore, normally we have to base on the market value and also the target capital structure or the optimal capital structure. Now we'll discuss how to determine the cost of debt, because before calculating this number, you should know each component cost. පාදන වර්ගවල පිරිවැය දැනගෙන ඉන්න ඕන overall cost of capital එක calculate කරන්න. So first we'll see cost of debt, marginal cost of debt. The cost of debt is the cost of debt financing to a company when it issue a bond or takes out a bank loan. So debt capital can be from as a bank loan, it can be as a bank loan or debenture, or it can be a bond. So likewise, those are the ways of raising debt capital. Can be a bank loan, or it can be a debenture issue or the bond issue. So likewise, there are ways to raise the debt capital. Weighted average cost of, when we estimate the weighted average cost of capital, this cost of debt should be adjusted for the tax. Why? Now here RD again, that is marginal cost of debt capital. So why we adjust tax? Because now if you look at these two extracts from the income statement, just look at this. Two extractions are there. This is unlevered. Unlevered means no debt capital. Leverage එකක් නැහැ. Unlevered. This is levered. Levered means they have debt capital in their capital structure, right? So you can see revenue both same, 180, here also 180. So expenses, say this is A, company A, say this is B, both having the same expenses, minus 70, right? Expenses, operating expenses, both having the same. So for the levered company, so you know there is a debt capital. So you have to, for the levered company, so EBIT mean earning before interest tax, before interest and tax. Unlevered mean there is no debt capital, there is no financing cost, or there is no interest. There is no financing cost. So therefore EBT directly you can work out EBT, earning before tax, right? Earning before tax, 180 minus 70, 110. Here you have to consider the interest, because this is levered. There is a 100 loan at 10% annual interest rate. So therefore interest cost is rupees 10. Right? Interest cost is 10 rupees. So therefore EBIT, earning before interest and tax. EBIT mean earning before interest and tax is 110. So then you have to deduct the interest cost or the financing cost. That is 10 rupees, because 100 into 10%, 10 rupees. Then earning before tax, 100 for the levered company. For unlevered company, earning before tax, 110. So now the tax rate assumed for the both is 40%. So you can calculate tax on this taxable income. Now here taxable income is 100. Here taxable income is 110. So you can see tax is 44 for the unlevered company. For the levered company, is tax amount is 40. Earning after tax, you can see both companies earning after tax. For the unlevered company, earning after tax 66. For the unlevered company, earning after tax is 60. Now, if you look at these two illustrations, very simple illustration, while this levered or the levered firm company, is paying 10%, is paying 10 rupees as the interest. Even though they are paying 10 rupees as the interest, you can see earning after tax. The difference between the earning after tax of these two companies is only 6 rupees. Now, only the one that expense have for the levered companies, this 10 rupees, that interest. Though this levered company paid 10 rupees as interest, look at the earning after tax for the both companies, their difference is only the 6. Even though they are paying the 10 rupees as the interest, really earning after tax impacted only by 6. So now, because of what? Because on this 10 rupees interest, this levered company is gaining tax saving, is gaining tax shield. Even though that bank is charging 10 rupees as the interest, from the company perspective, the real cost of this interest is not 10. The real or the true cost for the company is 6 rupees. Why? On this interest, that company is gaining tax saving. Tax saving. So that is why this earning after tax difference between these two companies 6. Even though they are deducting 10 rupees as the interest, the net income, earning after tax income, differed only by 6 rupees. Why? They are getting some tax savings. So therefore, when you compute in the cost of debt, this you have to consider. This you have to consider. Because this interest is tax deductible expense, when the interest is deducting before the tax, your taxable income is reducing by that amount. So therefore, your tax payment is reducing by that tax shield. Tax shield means that is 10 rupees or 10 rupees or 40% can amount again. Or pay no, the tax amount adu I make interest and cost capital. Namu take capital before tax adu karanda then a viyadama in the income statement. So because of that, you are getting some tax shield, tax savings. So then true debt cost is not the 10 rupees, it is 6 rupees. Because that 4 rupees you are gaining as the tax saving on this 10 rupees. So when you estimate the cost of capital for the company, you have to consider this incident. So then by adjusting tax, you have to calculate real or the true cost of debt. So then that number we are considering here. So here you can see this is after tax cost of debt. This is before tax marginal cost of debt. So we are multiplying it by 1 minus tax rate. So then you will get after tax cost of debt. So why we adjust this why we adjust, why, what is the requirement of doing this adjustment? Because of this reason. Now it is very clear. Now you can see here the difference between the earning after tax only 6, even though they are paying 10 rupees interest, but really impacted it only 4 rupees. So then the difference you can see only 6. Right. So therefore, after tax cost of debt, you can calculate before tax cost of debt minus tax savings. This is the tax saving. So tax saving or tax shield, some textbooks you can see it's named as the tax shield. So tax savings you can calculate before tax cost of debt multiply by tax rate. So then ultimately this, this formula you can simplify further to this formula. After tax cost of debt is equal before tax cost of debt 1 minus tax rate. Now here, even though that bank loan interest rate is 10%, but when you adjusted this for the tax, the true cost or the real cost of debt is not 10%, it is 6%. So when you estimate the cost of capital of the company, you should consider this number. This is the true cost of debt. This is the real cost of debt. This number is the one that you are paying to the bank. But on this interest, you are gaining some tax savings. So you have to deduct that. Company එකට බදු ඉතිරියක් ඇති වෙනවා මේ පොලිය මත. ගෙවන සලාක පොලිය මත. එතකොට ඒ බදු ඉතිරිය අඩු කරලා අපි real cost එක කීයද? Real සත්‍ය පිරිවැය කීයද කියන එක අපි ගන්න ඕන. So the real cost of debt to the company is not 10%, that is 6%. So that is why I think with that text illustrations, I think you realize the why, what is the reason for this adjustment. So on this tax saving, we have to get some, on this interest, you are getting some tax savings, so that you have to adjust. Right, so then that way you can adjust the cost of debt for the tax savings. This is applicable only to the debt capital. Because that preferred stock capital, no need to adjust, because that dividends we are paying after tax. So therefore, there is no any tax savings. For the cost of equity also, there is no any tax savings. So that is applicable. This we have to adjust only for the debt capital. Right, only for the debt capital. Right. So now, should our analysis focus on historical or the embedded cost or new marginal cost? Actually, I earlier also explained it, that cost, debt cost should base on the new or marginal cost, not the past or the historical or the embedded number. This number, this cost of debt, cost of equity, cost of preferred stock should be on the marginal or the new cost. Now, cost of capital is used primarily to make investment decisions that involve raising new capital. So relevant cost is the marginal cost of new debt to be raised during the planning period. Because now this cost of capital number we are using in evaluating our investment decision. So therefore, this investment is for the future, So we are investing today, but for the future. So therefore, the relevant number should base on the new cost, marginal cost. Now, say, you know that in case of the bond valuation, you can see, assume that a company, just look at this, 3 years ago, just look at this illustration, 3 years ago, JK PLC issued 10 million bond with 8% coupon. While the bond was initially issued at par, rise in interest rates over the last 3 years have caused them to sell at a discount. The yield on the bond is currently 9%. In order to finance expansion, company is considering another large issue of bonds, right? For an expansion, now company is considering another large issue of bonds. Now, I'm asking the question, what is the cost of new debt? Now, this is the situation in the JK PLC company. They have already issued the bond somewhere in 3 years ago, right? That coupon rate was 8% on the bond issue. Right now, with the prevailing market situation, interest rates has increased. So therefore, it says that bonds are now selling at discount. Bonds are selling now at discount. YTM, currently YTM is 9%. You know what is YTM, right? Bond valuation you have done. So now my question is, further this company is considering expansion. So therefore, they are considering to issue the new bond. So for this new bond issue, what is the cost? What is the cost? Is it 8% or 9%? 9%. Because this 9% is the YTM. 9% reflect current required rate of return. If you invest this JKPLC bond today, and if you keep this term until the bond and until the maturity, your realized rate of return would be 9%. This 8% is somewhere in past. When this JKPLC issue the bond in 3 years ago, they have considered coupon as 8% 3 years ago. But now you can see YTM is 9%. So therefore, what is the cost of the new debt? It should be 9%. If you take 8%, that is wrong. If it is 8%, investors may not attract for this issue because that rate is not fair. It's below the market rate. So therefore, investors may not wish to invest. So the relevant rate is YTM. So that is the here question. What is the one you have to use? You have to use YTM, not the coupon rate. Coupon rate is not current. It is normally we are deciding when we decide to issue the bond. On the prospectus, we mentioned this is the coupon rate. It is fixed amount, fixed rate. Is not changing. But YTM is changing on the based on the market interest rate. Based on the market interest rate. So therefore, YTM we have to consider. The before tax required return on debt is typically estimated using the expected yield to maturity of the company's debt based on current market values. So that's what I will explain now. YTM, what is YTM? Yield to maturity. Api singaling kena parinatayata paladavu. YTM. YTM is the annual return that an investor earns on a bond if the investor purchases the bond today and holds it until maturity. Once you purchase in this bond, if you keep this bond until its maturity, that YTM is your realized rate of return. It is your internal rate of return, IRR. So internal rate of return. It reflects the current market required rate of return, current market interest rate. So that is YTM. In other words, it is the yield that equates the present value of the bond's promise payments to its market price. Already මතකයි bond valuation වල මේ YTM එක calculate කරා. YTM එක කියලා කිව්වේ අපි අද invest කරනකොට අපි අනාගතේ බලාපොරොත්තු වෙන සියලුම expected cash flows වල present value එක market price එකට සමාන වෙන අවස්ථාවේ වට්ටම් සාධකය. Technically, that is the way we define it. It is the yield that equates the present value of the bond's promised payments to its market price. So technically, you can calculate YTM using trial and error method and identifying the range, and then linear interpolation method you can use approximately to determine the YTM. Or in the Excel, you can use the rate function. Right. So now this is our example. You are given example. You can read. Assume you are given following information of Alpha PLC. The current price of Alpha PLC is 12% coupon, semi-annual bond with 15 years remaining to maturity is 1,153.72 cents. So this is the current market price. Apart from that, you are given information related to the perpetual or the preferred stock of the company. And also it includes some information related to the common stocks of the company. And also market informations are given. Tax rate is given. Capital structure, target capital structure is given. So this is information related to the future calculation. Now we discuss cost of debt. Now we want to estimate cost of debt for the Alpha PLC. Currently, that company has bonds, semi-annual bonds. Their coupon is 12%. times remaining to maturity 15 years, right? Currently selling at 1153.72 cents. So now what you have to do? Now I am asking to calculate cost of debt of Alpha company. Cost of debt of the Alpha PLC. What you have to do? So you have to calculate what is YTM. You have to calculate YTM here. I believe that you know how to calculate YTM because in the bond valuation lesson, you have practiced it, YTM calculations. Now here you can have to have two rates and two values where this market value is included or live. That is the range, upper range and the lower range. So using this upper and the lower, and then using the linear interpolation method, approximately you can estimate YTM using trial and error method. Or in the Excel function, you can go to the rate function very quickly. You can work out the YTM. Even financial calculators, you can give this variables, values of these variables, and you can work out the YTM or IRR or rate. So now here, but anyway, for the exam, you have to use the trial and error method because you are not allowed to use the Excel or the financial calculator sometimes. So therefore, you have to know how to calculate the YTM using this trial and error method. Now, in order to apply this trial and error method, you have to identify the range. If it is if YTM is 12%, what is the market price of the bond? If YTM is 12%, what is the market price of the bond? Yes, 1000. So that we can take as a one number. If it is 12%, price is 1000. So we want to identify rate where that price is equal to 1153 rupees and 72 cents. So then this rate should greater than this one or less than, because now this bond is selling at premium. Normally, I think you may remember when the bond is selling at premium, coupon rate is greater than the recur rate of return. Coupon rate is greater than the recur rate of return. I think in the bond valuation lesson, you learn this relationship. When the bond is selling at premium, coupon rate is greater than the YTM. So then here YTM should be less than the 12% now. So I am trying with I am trying to get the value at the 9%. So if the YTM is 9%, what is the price here? Suppose YTM is 9%. So at 9%, what is the value? What is the market price here? So I'm trying to identify the range, right? So I have, you can work out using the calculators. Yes, 1240. Yes, correct. If YTM is, if assume YTM as 9%, then value is 1244.33. So now range is okay. We want to identify the range where this 1153 is live. So therefore, our linear interpolation table is okay. So based on these two values, two rates, you can forecast approximately YTM. At 9%, value is 1242.44.33 cents. We are going to identify this one. When Market price is 1153. What is the value here? So we are going to forecast it. So you can use this approximation table formula. So simply you can work out and you will get, I think you know now, this is very simple argument. If the 244.33 rate is differed by 3%, right? We are taking the large number and the lowest number. Say this is delta 1. So this is the delta 1. Difference between the large value and the lowest value, that is 244.33. For this difference, rate has differed by 3%. 9 to 12, no? It has differed by 3%. Then for this difference, say this is delta 2. This is delta 2. For that difference, this rate should increase by how much? The difference is 90.61. So 9% should increase by how much? So you can simplify, you can calculate. You will get this number, right? You will get this number. So this is the YTM. This is how trial and error method we apply to calculate YTM. Did you get this answer, anyone? Did you get this number 10.1 by solving this? Did you find this? 10.1 approximately? Yes, no? Right. So now this is one method. This is what you have to use in your exam. But anyway, you can go to the Excel, use the rate function simply, right? So using the rate function even, you can estimate the YTM. If you go to the rate function, you can input, you can insert this number in 430. Present value is 1153. Periodic payment is 60. So I will let you say, I will, 1 minute, I will show you that.
Excuse me, madam, how did you take this 1000?
1000 I just simply take because in the bond valuation, you might have learned this relationship. When the YTM is equal to the coupon rate, bond is selling at par. So on that theory, I took as the 12%. And if the YTM is 12% here, then price of the bond should 1000. Wala bond valuation එකෙදි ඉගෙන ගත්ත relationship තුනක්. Bond එකක් par value එකට විකිරෙන්නේ කොයි වෙලේද? Bond එකක් when the bond is selling at premium, when the bond is selling at discount. When the normally bond is selling at par, coupon rate is equal to the YTM. That is given relationship. So on that I took the 1000. If the YTM is 12%, so market price is 1000. ඔයාලට මේ calculate කරලා බලන්න පුළුවන් 1000 තමයි එන්නේ.
Okay, madam, thank you.
Okay, right. So then එකක් 1000 කියලා ගත්තා. අනිත් එක මම 9% දීලා බැලුවා කීය දෙන්නේ කියලා. ඒතකොට දැන් range එක හරිනේ 1244යි 1000යි අතර මේ number එක තියෙනවා. So then you can do the you can do the linear interpolation method. 1244 ගත්තට නම් මම කියලා දෙන්න අවශ්‍ය නැහැ කියන උපකල්පනයේ තමයි මම ඉන්නේ. මොකද bond valuation වල කරලා තියෙන හින්දා. Anyway, we'll give 1 minute. Now here I took it as a 9%, right? So at the 9%, I calculate the market price of the bond. So value or the market price of the bond is equal. Coupon is like annuity. So we take the present value of this annuity 1 plus R into the power minus n divide by R plus redemption price or the par value 1000 divide by 1 plus R into the power n. So using this formula, you can calculate market price of the bond or the value of the bond when YTM is 9%. So here coupon here 12% coupon. Normally book value or the par value of the bond is 1,000. This is semi-annual one. So 12% annual coupon, then 120. Then semi-annual coupon is 60 into 1 minus. Now here I have get the 9%. This is annual YTM or the annual interest rate. So semi-annual mean R you have to divide by M, no? So then it is 1.045. Minus N here, semi-annual bond with the 15 years remaining to maturity. තව අවුරුදු 15ක් තියෙනවා මේක mature වෙන්න මේ bond එක. So therefore N here 30. This is semi-annual 15 into 2 divided by 0.45 plus 1,000 discounted by 1.045 into the power 30. So you can solve this. You will get 1,244.33. Okay. Yes, in the questions normally, in the bond valuation questions, normally it will not give the bond par value. Normally you have to consider it as 1,000. It's assumption. So you have to take it as 1,000. එතන මෙතන මේ රේන්ජ් එක ගන්නකොට කෙයාෆුල් වෙන්න මේ රේන්ජ් එක ඇතුලේ මේ අපි සීක් කරන වැලියු එක අපි හොයාගෙන යන වැලියු එක තියෙන්න ඕන. Otherwise this linear interpolation is wrong. It is wrong. This high value and the lowest value, in between this highest and the lowest value, the seeking value should lie. Otherwise you can't do the linear interpolation. The linear interpolation means අර සරල රේඛාවක් මත ලක්ෂ දෙකක් දන්නවා නම් මෙහෙම අපි ලක්ෂ දෙකක් දන්නවා නම් මෙතන ලක්ෂයක් ફોකස් එක කරන එකනේ මේ linear interpolation කියලා කියන්නේ. අපි මත ලක්ෂ දෙකක් දන්නවා නම් අපිට තව ලක්ෂයක් ફોකස් කරන්න පුළුවන් based on this linear relationship. So that is what is we applied here. Linear interpolation method. එතන මේ ලක්ෂ දෙක මේ අපි ફોකස් කරන්න යන එක වැටිලා තියෙන්න ඕනේ ලක්ෂ දෙක මත ඒ point එක මත range එක මත. Right, anyway this is bond valuation, right? This is not the cost of capital. Right, now here another way that you can use, actually I will show the how to use this one also. You can use the Excel rate function, right? Excel rate function also you can use to calculate the YTM very easily. Don't but anyway for the exam you can't do that. I will show you that. I think you can see my Excel screen, no? So here in the Excel you can use this function. In the function there is a function called rate. So click on it. So then you give the values for that. NPR mean number of payments period. So in our example it is 30. Periodic payment 60 because 120 is the coupon, but since this is a semi-annual one, so it is 60. Present value is 153.72. Future value is 1,000. So likewise, you can approximately calculate, I think using this also. Normally when you put the present value, you have to put the minus sign here, right? Otherwise that number is not there. So you can see rate is 5%. 5% means this is semi-annual one, right? So therefore you have to multiply this by the 2. Then it is approximately 100. Then it is approximately 100. So rate function also you can use to calculate the YTM. calculators පාවිච්චි කරන්න පුළුවන්. If you have a financial calculators, this rate function like formula you can derive to estimate the YTM or the IRR. But anyway, I think most of you are using the scientific calculators, not the financial calculators. So therefore, you have to calculate like you are using the time value of money. But anyway, in the Excel, in practice for your personal decision making, you can use the rate function. Someone asked me 60 here. Now here 12% is the coupon, right? It is in the question 12% coupon. Normally coupon rate is 12%. So you can calculate coupon 1000 into 12%. This is the annual coupon 120. But this bond is semi-annual coupon bond. So then semi-annual coupon bond is 60. Semi-annual coupon bond is 60. So that is how 60 came. Okay. Annuity present value calculation formula, I think formula sheet you will get in the exam. So it includes risk return, the formulas or the equations you use in the risk return topic will include in this formula sheet, and also this present value, future value, due ordinary annuities, everything will include in the formula sheet. So therefore no need to have by heart, but anyway take the rationale on this formula, then no need to by heart, so then you will remember that. But anyway you will get the formula sheet, don't worry about that, right? So now YTM is 10%. However, this YTM is not the one that you can use in the cost of capital calculation. This is YTM, but before tax. YTM, this is before tax. We didn't adjust for this. We didn't adjust this for tax. This is before tax. This is before tax. So now you have, in order to get the cost of capital calculation, this cost of debt, you have to adjust for the tax. So this is before tax number. But anyway, in this company, the firm tax rate is 40%. Firm tax rate is 40%. So therefore, real cost of debt is, you can calculate real cost of debt is how much? This YTM you have to adjust for the tax. So you can adjust it after tax cost of debt RD, right, is equal before tax cost of debt into 1 minus tax rate. So before tax cost of debt here 10.1 multiplied by 1 minus 0.4. So how much the after tax cost of debt? Around 6 point something, no? 6 point something or 6% approximately. So therefore, this is the number that you are using for the cost of capital calculation. If you take this one, that is not real. It's not, it won't give you the real picture. Company එකේ cost of, කියන්නේ company එක coupon එක විදිහට මේ මෙච්චර ගාණක් ගෙවනවා තමයි, මෙච්චර cost එකක් තියෙනවා. නමුත් ඒ මත මෙයාලා ගන්නවා tax ඉතිරියක්. tax බදු ඉතිරියක් ගන්නවා. tax saving එකක්. ඒතර real cost එක වෙන්නේ මේ 10.1 කියන එක මත ඒ බදු ඉතිරිය අඩු කරාට පස්සේ අපිට තියෙන cost එක. So that is around 6%. So this is about the cost of debt. So next we are moving to the cost of preferred stock. So this is very easy because no any tax adjustment. What is the investor's required rate of return? What is the preference shareholders required rate of return? It is same as the company's point of view, cost of preferred stock. So is the cost that a company has committed to pay preferred stockholders as preferred dividend when it issue preferred stock. So api වරණීය කොටස් හිමියන්ට ගෙවන්න පොරොන්දු වෙච්ච ලාභාංශයම තමා 10% කියලා කියමුකෝ. අපේ cost එක වෙන්නේ. Because there is no tax savings. There is no tax shield. So whatever the things that we are promised to give for the preferred stockholders, it is our cost. It is our cost. The return investors require on a firm's preferred stock. That is the cost of preferred stock. So cost of preferred stock you can calculate simply and you can use in the cost of capital formula. This is also marginal cost of preferred stock. අපි මෙතන ගන්නකොට අපි ගන්න ඕන future target capital structure එක මත marginal cost එක. ඒතර මෙතන පෙන්වන්න ඕන අර past value නෙමෙයි market price එක. again අපි preference share issue කරන්න ගියොත් අපිට අදාළ වෙන cost එක. So that is the marginal cost of preferred stock. Preferred dividends are not tax deductible, so no tax adjustments are necessary. I explained it. Just as nominal RP, you can take as the cost of RP. So flotation cost can be there, but anyway, this is very insignificant amount. So therefore, in cost of preferred stock calculation, this flotation cost you can ignore. This is very small number, so therefore we just ignore it when cost of capital calculation. So the cost of fixed rate perpetual preferred stock can determine by using this formula. So this is unredeemable. Unredeemable. I think in the preferred stock there are two versions. There are two versions: redeemable and unredeemable. With maturity and without maturity. Preferred stocks, they are with maturity and without maturity. So if it is with maturity, that means if it is redeemable. If it is redeemable, I have not included some example here. Like in this bond valuation, so you have to calculate the IRR. If it is redeemable, you can identify two expected cash flows, annual dividends, and redemption price. So based on that, you can calculate prices and identify the ranges where that market prices lie. And then using the linear interpolation method, by applying this method, approximately you can work out the YT. But anyway, in the preferred stock, no need to adjust this for the tax. That is only the difference. But anyway, if it is perpetual type, that means that is unredeemable, perpetual. So simply you can calculate cost of preferred stock, dividend divided by price, current preferred stock price. If it is unredeemable. Unredeemable means no maturity. Right? So then you can calculate dividend payment, annual dividend divided by market price. PP means that is the current preferred stock price per share. DP is the preferred stock dividend per share. Cost of preferred stock is the RP. So here we are using the, in case of the security valuation, preferred stock valuation, do you remember we apply this formula? I think Professor Champa was the one who explained this. So when you doing the security valuation, under the security valuation related to the preferred stock valuation, when it is unredeemable preferred stock, the formula you use to calculate the value is this one. Dividend divided by required rate of return. Dividend divided by required rate of return. So same formula we are using here to calculate this RP. Nothing new, right? Nothing new in the security valuation. You have applied this formula. Same formula we are reorganizing for the RP. So then cost of preferred stock is equal dividend divided by price. Now, this is not the beta, right? Alpha PLC cost of preferred stock. So if you go to the example here, what is the information relevant to the preferred stock? It is there. The issue price of 10% perpetual preferred stock was 116.95. If the company issued new perpetual preferred stock today, the preferred dividend yield would be 5%. There is a perpetual type preferred stock currently selling for 116. Right, currently selling for 116.95. The company issued new perpetual preferred stock, the preferred dividend yield would be 5%. So simply you can calculate this dividend divided by price. So in this case, you can calculate for the Alpha company, their dividend you can calculate 10% perpetual stock, 10%. So normally for the preference shares, par value is 100. So therefore 100 from 100, 10%. So that means 10 rupees. So then you can calculate Alpha company cost of preferred stock is equal, dividend is 10 rupees, divide by market price 116.95. So how much the answer? It is 8.5. So this is the cost of preferred stock. This is perpetual type. This is perpetual type, right? This is perpetual type preferred stock, 8.5.
Madam, excuse me. Here we have to assume that the par value is 100, no, ma'am?
Actually, yes, because in case of the preferred stock, par value is 100. In case of the bonds, par value is 1000. It is normally acceptable value. So in the question, normally sometimes it doesn't say that 100 par value preferred stock. So like it doesn't say. So therefore, you have to take it as the 100. In the bonds, you have to take it as a 1000. Okay.
Okay, madam. Thank you.
Madam,
Yes.
the previous slide cost of preferred stock, we calculate as it is without any adjustment, right?
Yes.
In this case, because of perpetual type, we do small adjustment.
Yes. I didn't get your questions. Can you repeat it?
Then the previous slide, you told us there is no adjustment. We can floating cost, they can ignore it and can be taken as it is.
Yes. For the preferred stock, no?
Yes, yes, madam.
Yeah. For the preferred stock, we are just ignoring the flotation cost. But if in the question it says that flotation cost should be considered, then this flotation cost should have to adjust for the price. Then ගානේ කියලා තිබුණොත් flotation cost එක consider කරන්න කියලා, so then you have to adjust this flotation cost for the price. Dividend divide by price into 1 minus flotation cost. Okay, but in this question it is very significant. It is very not significant, so therefore we just ignore the flotation cost. But anyway, if the question asks you to adjust the flotation cost, this price you have to adjust for the flotation cost. flotation cost normally you can have as a percentage, say 8%. So this price, then you have to adjust for the flotation cost. But in this example, we are not adjusting this flotation cost. Right?
Okay, madam.
Yes, in the question it says that, I also thinking about that. The issue price of 10% perpetual preferred stock was 169.95. If the company issued new perpetual preferred stock today, the preferred dividend yield would be 5%. So now in the question it says marginal cost of preferred stock is given. Now based on the past or the already issued preferred stock, if you calculate the number, it is 8.5. If you calculate based on the already issued one. But the marginal cost of preferred stock is given in the question as 5%. If new issue, right? Then you have to consider that, right? If company issued new perpetual preferred stock today, the preferred dividend yield would be 5%. What is the meaning of that? If company issue the preferred stock today, the preferred dividend yield would be 5%. But anyway, based on this model, based on this formula, if you calculate the cost of preferred stock, it is 8.55. Then අපිට numbers දෙකක් ඇවිල්ලා තියෙනවානේ. But investors require rate of return. Investors mean preference shareholders expected preferred dividend is 5%. Now it is 10%. No. Then මෙතන 10% නේ තියෙන්නේ මේ දැනට already issue කරලා තියෙන එක perpetual dividend එක 10%. But in the question it says that you can look at this statement. If the company issued new perpetual dividend stock today, the preferred dividend yield would be 5%. So what indicate this? What indicate this number? The current or present investors, present preferred stock investors required dividend is around 5%. Now here there is no any tax adjustment or things. So therefore, either you can use 8.5 or 5%, because at the 5% also that in the marketplace, this issue is attractive. Why? Investors' expectation is around the 5% in the market. So then you can consider this number even rather than giving the 8.5 dividend on the preferred stock. So that's why I have put here 8.5 or 5%. If you are going to give the more than the 5%, so that means that investors are very much attractive for that, no, rather because their expectation around the 5%. So at least around the 5% that marketplace is reflect their expectation. So at the 5% also you can issue the preferred stock dividend because in the marketplace it's around 5%. So that's what it given. Are you clear it? The make a gane කියලා තියෙනවා. If the company එක other prepared stock issue කරන්න යනවා නම් expected preferred dividend would be 5%. හැබැයි අපි මෙතන cost එක calculate කරොත් based on our existing structure, based on our existing, so that is 8.5. So either 8.5 or 5% you can use. So which is prefer? Which one? So which one you should use? Now I am asking question. Which is you are using 8.5 or 5%?
As a company, madam, we can use 5%.
5%. Yes, you can use 5% because no point of giving the more than 5. No, in the marketplace it is around 5%. So this statement is given in the question. Actually, no need to calculation even. So simply you can take the cost of preferred stock using this statement. But anyway, if you calculate based on the existing perpetual preferred stock, it is 8.5, more than 5%. But anyway, we can use the 5%. So that is the meaning. There is no any tax adjustment. 5% as it is, you can use 8.5. Yes.
Excuse me, madam. Just assume after calculating this value, if we get a value lower than the 5%, then what is the value that we have to use?
Again, you have to go with the 5% because that market status is given. No?
Right.
මේ ගානේ දීලා තියෙනවා. ඒතකොට අපි සාමාන්‍යයෙන් marginal cost of preferred stock නේ ගන්නෙ. marginal cost එකනේ. ඒතකොට අපි මෙතන calculate කරලා එන value එක එන්නේ past නැත්නම් අපේ existing structure එක තුල. ඒතකොට දැන් මෙතන ඉගියක් දීලා තියෙනවා current cost එක ගැන. So that is the one. ඒතකොට ඔයා අද issue කරන්න ගියොත් ඒක තමයි ඔයාට relevant cost එක වෙන්නේ. Not the one that you are already that you are calculating. Not the one you are calculating. Say, if you calculate it, if it is say less than 5%, still you have to use this one. Otherwise, your issue, your preferred stock issue would not be attractive. Investors may not invest. May not invest in because this is the marginal cost of preferred stock in the market. මේ දීලා තියෙන marginal cost එක. දැන් මෙතන අපි මේ calculate කරන්නේ අපේ දැනට තියෙන information මත. මේක this is not marginal, actually this is historical, this is embedded, but this is the marginal one. So you have to go with the marginal one because we are estimating here marginal cost of capital. No, because this cost of capital is for future decision making. අපිට දැනට තියෙන cost එක පිළිබඳ අවබෝධයක් ගන්න නම් අපි මේ estimate කරන්නේ. So you can come with the 8.5 even. But anyway, we are estimating cost of capital for the future investment evaluation. So then you have to go with the 5%. Are you clear that? That's very important point. Are you clear?
Yes.
Because,
in the question, if we have given this marginal value, no need to calculate.
No.
Right. Thank you.
But anyway, අපි හිතමු මේක දීලා තිබුණ නැහැ කියලා මෙහෙම එකක්. The statement is not in the question. Assume that it was not there in. Then you have to calculate this one. So we assume this as the marginal cost of preferred stock, marginal cost. But anyway, in the question correctly says, if you are issuing new preferred stock today, the preferred dividend would be 5%. So that is the updated current existing market. So you have to go with that number. Right. So this is about the preferred stock calculation. But the other thing actually I didn't explain. So this is related to this one, unredeemable. If it is redeemable, okay, I will give a question. I will give you a question and I will let you 5 minutes to do that, right? Assume, just write down this question. Just write down this question. This is not related to this example, right? It's a separate example. Assume that JK PLC has issued, just write down, right? JK PLC has issued 100 rupees, 100 rupees, 100 rupees, 100 rupees, 6% preferred stock. Preferred stock. JKPSC has issued 100 rupees, 6% preferred stock. It's with the remaining time to maturity. With the remaining time to maturity, right? Time to maturity of say 10 years. 10 years. Further, this stock currently selling at. Currently, this preferred stock is selling at in the marketplace for rupees 87 rupees or 87 rupees. This is the information, right? Simply information. For the exam, you would have such a question sometime. No, either JK PLC has issued 100 rupees, 6% preferred stock with the maturity of remaining times to maturity of 10 years. right, with the maturity. So the remaining time to maturity is 10 years. Currently, this stock, preferred stock, is selling at 87 rupees. So what is the cost of preferred stock? What is the cost of preferred stock? Now, how do you calculate this? What is the cost of preferred stock? How do you calculate that? So company has issued 100 rupees, 6% preference shares times remaining to maturity is 10 years. 10 years, no? 10 years. Currently selling in the market at 87 rupees. So simply those are the information. So I am asking here, what is the cost of preferred stock? So this is the one with the maturity. Preferred stock can be with the maturity and without the maturity. Redeemable and unredeemable. නිදහස් කළ හැකි සහ නිදහස් කළ නොහැකි කියලා දෙකක් තියෙනවානේ වර්ණීය කොටස් වල. So එතකොට මේ වගේ එකක් ආවොත් this is a redeemable. In 10 years this stock is redeemed. So this is redeemable. So now what you have to do? What you have to do? I think you can see the screen. So what you have to do? Now you have to calculate cost of preference shares using that linear interpolation method. So you have to go with the trial and error method. But I need to highlight that one because in the questions and in the PowerPoint, I have not included that area. But anyway, if you received the preferred stock with the maturity, then you have to go with, like in the bond YTM calculation, you have to calculate the IRR here or the YTM here. So then we can work out 7.93. Anyway, we'll try. So as a beginning, you have to work out, you have to start using calculator, right? As a beginning, you can start with some number. Say, I am starting with, say, 8%. At the 8%, I am seeing the value, whether it is equal to 8.7 or not. This 8% is totally assumed value. No rational here. But in the bond valuation, there was a rational. Bond valuation or rational එකක් තිබුණා. Premium එකකට විකිනනවා නම් මේ දෙක අතර සම්බන්ධතාවයක් තිබුණා. Discount එකකට විකිනනවා නම් මේ rates දෙක අතර සම්බන්ධතාවය. නමුත් here no any relationship. So I have to start with some number. So I start with the 8%. So at the 8%, see the value how much? Just calculate. Coupon here 6 rupees. So 6 rupees is an annuity. So as annuity, you have to discount it. So 1 minus 1.08 into the power minus 10 divided by R, that is 0.8, because 8, that's what I suppose, assume. And the maturity you are getting the 100. This is the redemption price that you have to discount for 10 years, 1.08 into the power 10. What is the value is coming here? Quickly do that and give me the answer. Just show how to do that. Here the value again make a solve karwa quickly, please. $86.58. So you are getting $86.58, approximately very close to this one. $86.58, right? So luckily you end up with a very close price, $86.58. But anyway, අපි හිතමු අපි මෙතනට ගත්ත කියලා 100ට අපි හිතමු මෙතනට 7ක් වගේ ගත්තොත් කීයද එන්නේ කියලා කියන්නේ. එතකොට දැන් ඔයාලා එහෙම ගත්තා නම් මෙතනට එනවනේ යම් වැලියු එකක්. 107 ගත්තොත් කීයද එන්නේ? දැන් මේක නම් ඇත්තටම අපිට මේක විදියටම ගන්නත් පුළුවන් YTM because 86.58 mean approximately 87. But just consider 7% here. Just show me you the method. What is at the 7%? මට කරන විදිය පොඩ්ඩක් පෙන්නන්න. දැන් මේක විභාගෙ නම් ඔයාලට කෙලින්ම 108 කියලා ලියන්න පුළුවන්. but anyway 107 දී 92ක් එනවානේ, right? That is around 92. 92.98. Okay, 92.98, right? So we are seeking here 87 at the 7%, 92.98. But we have to now reduce this value because we are seeking 87. 87 වෙනකොට rate එක කීයද කියලා තමයි මේ හොයාගෙන යන්නේ. එතකොට අපිට දැන් 92 අඩු කරගන්න නම් so you have to increase the 7%. Just look at the 9% කීයද එන්නේ කියලා මට කියන්න. 92 point you have to reduce now because we are seeking 87. So in order to reduce the 92, you have to increase the discount rate. So I am increase it at to 9%. So how much at the 9%? At 9%, 85. Right. So now I think range is okay. 80, 85. So we are seeking 87. So when the 92 is decreasing like this, 87 is there. So now our interpolation table is okay. It is greater than 7%. At the 7%, value is 92.98. We are seeking where the 87. So that rate we are going to find. So when it is increased to 9%, it is 80, 85. So this is our linear interpolation table. The table is okay. Now based on this table, you can do the forecasting. So cost of preferred stock approximately based on this method equal, it should be greater than 7. It should be greater than 7. Then the difference between large value and the small value. So this is delta 1. How much the difference here? 92 වලින් 80 85 ගිවම් කීයද? 92.98 minus 80.85, 12.13, no? For the 12.13 difference, the rate was difference by 2%. Then for that difference, මෙතන difference එක කීයද? 92 වලින් 8 minus 87, 5.99, sorry, 5.98. 5.98. So now solve this. 0.02 divided by 12, 1.3 multiply by 5.98. Is it around here? What is the answer? 0.0000 වගේ ගන්න දෙන්න. What is the value you are coming after solving this? I haven't my calculator with me, right? 7.98, no, approximate you are getting the value. Even with the calculators, you get this number. So this is the way when you have to do when preferred stocks with the maturity were given. But in our example, it is one perpetual preferred stock. This is unredeemable. But if it is a redeemable like this, you have to go with this trial and error method and the linear interpolation. So this is the cost of preferred stock. This is the cost of preferred stock. Right. So this is about the cost of preferred stock. So now we are moving to the last one, that is cost of equity. Cost of equity is the rate of return required by company's common shareholders. Not like the cost of debt, cost of preferred stock. Estimation of the cost of equity be difficult because identification of the expected cash flow is difficult. Because for the common equity holders, there is no fixed dividend. There is no fixed dividend. So dividend depends on the performance of the company, profits of the company. So therefore, estimation of the cost for the preferred stock holders is, equity holders difficult compared to the previous two. Company may increase common equity through the reinvestment of earnings, that is retained earnings through the issuance. So in the cost of common equity, there is a two type. That is, I earlier also mentioned, internal and external. Internal means that is through the retained earnings. That is through the retained earnings. Company may increase the common equity through reinvestment of earnings. So that is retained earnings. So retained earnings belongs to the common equity holders. Api උපයපු ලාභයෙන් ලාභාංශ ගෙවන්න නැතුව ප්‍රතිආයෝජනය සඳහා for the reinvestment we are retaining something. ඒතොර retain කරගන්න earnings අයිති කාටද? For the common shareholders. There is no right or claim for preferred stockholders or the debt holders. That is all. The right is with the common shareholders, and also by doing the new issue. By new issue, so you can. That is we call external equity. External equity and internal equity. So in the cost of equity, there is a two parts. That is internal equity and external equity. So internal equity through the retained earnings, external equity through the issuance of the new shares. So in our fundamental formula, this is the cost of equity part. RS here we are using for the internal equity. RE we are using for the external equity. External equity. RS refers to the common equity using retained earnings. Common equity using retained earnings. The rate of return investors require on the firm's common equity using new equity. That is the term we are using RE. So both RS, RE are using to reflect the cost of equity. RS, cost of internal equity. RE, cost of external equity. Earnings can be reinvested or pay. Now, why there is a cost for retained earnings? Because retained earnings are the earnings that company earn. Is there any cost? Is there any cost? If it is the company's profit, what is the cost? Company එක උපයපු ලාභමනේ අපි retained earnings කියන්නේ ඒක කාගෙවත් ඉල්ලගත්තේ නැහැනේ. So are there any cost for the retained earnings? Yes, there is a cost. That is opportunity cost. Earnings can be reinvested or paid out as a dividends. අපි උපයන ලාභයෙන් කොටසක් අපිට ලාභාංශ අපේ තියෙනනේ ලාභාංශ ප්‍රතිපදය. We have a dividend policy. We have a retention ratio and also we have a payout ratio. From the profit, we retain something as well as we distribute something as the dividends payout. So earnings can be reinvested or paid out as a dividends. If we retain, we are reinvesting them. If we retain them, we are reinvesting them. Investors could buy other securities, earn a return if these dividends declared to the investors or the common shareholders, so they can reinvest them in another company or another project, so they can earn a return. If this dividends or if this earnings retained by the company, director board decided to retain 50% of their earnings for the reinvestment, then earnings are retained, there is an opportunity cost. There is opportunity cost. If return that stockholders could earn on alternative investment, at equal risk. So that is the opportunity cost. So therefore, even in the retained earnings, there is a cost because there is a huge opportunity cost. Currently, they are sacrificing these dividends for the future return. So if we are expecting some more return in future, but they are exposed into the high risk, exposed into the high risk in the future, you know, there is uncertainty. We have to wait some time. So therefore, this is with the high risk. But anyway, there is a large opportunity cost. They have lost their next best return. They have lost their next best good investment. So that is the cost in retained earnings. So therefore, if I ask a question, are there any cost or why are there any cost for the retained earnings? Yes, there is a cost. That is the opportunity cost of the common shareholders. Their next best investment if they receive the dividends. So likewise, you can explain that cost. The estimation of the cost of equity is challenging because of the uncertain nature of the future cash flow. Because not like in the debt, not like in the preferred stock, for the common or the equity shareholders, they are not receiving stable dividends. They are not receiving fixed dividend. In some years, they are getting more dividends. Some years there are no dividends. So they are getting some fluctuating dividends. So we can't forecast very accurately because of that variable or because of that nature. I think in the security valuation also common stock valuation is difficult. In the security valuation topic, I think you may remember when you are doing the common stock valuation, do you remember you use different methods? You use the different methods. Single holding period, multiple holding period, constant dividend model, constant growth model. So likewise, you use the different models. So because of why their dividends are not fixed. So forecasting or identifying their expected cash flow is very difficult. In practice, analysts may use more than one approach to develop the cost of equity. Because of this nature, we also here using different approaches to estimate the cost of equity. Cost of internal equity, here we are discussing RS, right? Cost of internal equity. So you can use CAPM, dividend discount model, bond yield plus risk premium method. So CAPM and bond yield plus risk premium method are mostly using in the practice to estimate the cost of equity. DDM also we are using if there is a constant dividend or for the established companies they can use. So these are three methods, but there are more. But anyway, I have put only the three methods, three approaches to estimate the internal cost of equity, right? So when I say the CAPM, now it is not new for you. You know what is CAPM? What is the relevant risk in CAPM? It is the market risk. How to measure the market risk in the CAPM? Using beta coefficient. Beta coefficient measure the risk of a security related to a portfolio, not a single stock or the standalone risk. I think you remember I explained all the things related to this CAPM. The same CAPM model we are applying here to estimate the cost of equity. So now these numbers, these letters are not new for you. When we say the RF, this is the rate of return expected on risk-free investment. RM here, this is market return. B, this is actually this should be beta, right? This is beta. You know that this beta coefficient, how to measure the beta coefficient. Covariance, stock I with the market, divide by the variance of the market. So this CAPM explained the expected rate of return of a security or portfolio, either efficient portfolio or inefficient portfolio. You can apply the CAPM. Remember security market line, our previous discussion. So we can use the security market line to measure, to calculate the cost of equity. So we'll see that. CAPM theory or the CAPM model that explain expected return on stock is the sum of risk-free rate of return or risk-free rate of interest and premium for bear in stock market risk. Premium for bear in stock market risk. I think you may remember this is risk-free and this is risk premium. This is risk premium. Here risk premium mean actually the risk premium for bearing the market risk. Market risk. What is this market risk? It is systematic risk. It is systematic risk. It is the one that you cannot diversify away even having well diversified portfolio. So investors should compensate only for bearing the market risk. So here ERM, the expected return on the market. You know what is market? Is our market portfolio. In Sri Lankan context, it is the return that we calculate based on the all share price index. That is our market. So you can calculate market return based on the all share price index. Risk-free is the government treasury bond, treasury bill rates we are using as proxies for the risk-free. So the difference between market return and risk-free, we call market risk premium. We call market risk premium. So market risk premium is the premium that investors demand for investing in market portfolio relative to the risk-free asset. So this is the premium given in the market for bearing systematic risk. This market risk premium is the premium that investors demanded for investing market portfolio. What is market portfolio? It is the risky portfolio. It is the risky portfolio. එතකොට risky portfolio එකේ invest කිරීම වෙනුවෙන් request කරන premium එක තමයි market risk premium එක කියලා කියන්නේ. So it is the market premium that in the marketplace we pay for the systematic risk. So we multiply it from our beta, our stock beta. Then you could have our risk premium. Market risk premium multiplied by the beta coefficient. So then this is the risk premium. This is the risk premium. So then plus risk-free rate is the expected return in the market, or this is the cost of equity capital. This is the cost of internal equity. So the same model we are applying here to calculate the cost of equity. So if you know the market information, if you know the risk-free rate, market return and beta, then you can apply the CAPM. Then you can apply the CAPM to calculate the cost of equity, simply. Now assume Jumbo Industries wants to know its cost of equity. Its chief financial officer believes that risk-free rate is 5%, market risk premium is 7%, and Jumbo's equity beta is 1.6. So here 1.6. 1.6 means Jumbo Industries systematic risk is greater than the market portfolio risk even. So this is high risk situation, 1.6. This is greater than 1. Greater than 1. Always in the market portfolio. Always in the market portfolio, systematic risk is equal to the 1. If it is greater than 1, it means this security or this Jumbo Industry securities or this company is more riskier even than the market. If I elaborate more, when the market portfolio return increased by 10%, this stock's returns increase by more than 10%. And opposite of that, when the market portfolio return decreased by say 1%, this stock returns, this company's return decreased by 1.6%. So more than 1%. So they are high risky, higher the risk, higher the return, higher the return, higher the risk. So this is why 1.6. එතන 1.6 කියලා කියන්නේ අපිට මේක දැක්ක ගමන් එයාගත්ත හැකි මේක රිස්කි මේ කම්පැනි එකක්. අයි මාකට් එකේ රිස්ක් එකටත් වඩා වැඩි. මාකට් එකේ රිස්ක් එක හැම වෙලේම එකයි. මාකට් පෝර්ට්ෆෝලියෝ එකේ බීටා එක always is equal to the 1. Beta is always equal to the 1. Now here this jumbo industries beta greater than this 1.6. ඒ කියන්නේ මාකට් එකටත් වඩා වැඩියෙන් මේක රිස්කි. මාකට් එක එකකින් වැඩි වෙනකොට මෙයා 1.6කින් වැඩි වෙනවා. හැබැයි මාකට් එක එකකින් බැස්සොත් මෙයා 1.6කින් බහිනවා. ඒතකොට 1.6කින් බහිනවා කියන්නේ collapse එක. නැගන එක හොඳයි. නගිනකොට is okay, but when it is a collapse or when it's a declining affected worstly. So now what is jumbo's cost of equity using CAPM approach? So you can apply the CAPM. So case is equal relevant risk-free rate here 5%. So 5% plus risk premium. You are given directly market risk premium is 7%. So 7% multiplied by beta 1.6. So how much? 16.2. Hmm? 16.2 ने को मतलब right. Hurry. Here 16 point. What is the answer here? 16.2 then. Hatai. Yes, no? Yes, 16.2. Right. So that way you can apply the CAPM to estimate the cost of equity. Now, look at our example. For the common shareholders, for the cost of capital calculations, for the calculation of the cost of equity, you are given information related to here, this bullet, and also some information are there in this bullet, and also this bullet. Now here it say common stock is currently selling at 50 rupees per share. Its last dividend was rupees 4.19. And dividends are expected to grow at a constant rate of 5% in the foreseeable future. Issuing new common stock incurs flotation cost of 15% of proceeds. So this is not relevant to the CAPM. Look at the next one. Alpha PLC's beta is 1.2. Yield on treasury bill is 7%. Market risk premium estimated to be 6%. So now you can apply CAPM here. So simply applying CAPM, calculate the cost of equity. Cost of equity RS here is equal. So we are applying CAPM here. How much? Risk-free rate is 7%. Those are the numbers. No, risk-free rate is 7%. Market risk premium, right? Market risk premium 6%, beta 1.2. How much the answer? Yes, 14.2. This is the estimation based on the market and beta, market information and beta. So using the CAPM, cost of equity, internal, right? Internal cost of equity is 14.2. For companies with publicly traded, for the companies with publicly traded debt, the bond yield plus risk premium approach provides quick estimate of the cost of equity. Now, the next one I am discussing is this one, bond yield plus risk premium method. Right? Bond yield plus risk premium method. For the companies who have traded debt, they can apply this bond yield plus risk premium method, which give quick estimate of the cost of equity, because you know the logic. Now, normally, you know that when we consider the risk, debt that equity holders bear in more risk than the debt holders. I think you remember that figure diagram. So therefore, equity holders required rate of return is higher than the debt holders required rate of return. So on that logic, here this bond yield plus risk premium method is developed. Bond yield එකට බැඳුම් කරවල පළදාවට risk premium එකක් එකතු කරනවා. ඇයි අපි risk premium එකක් එකතු කරන්නේ? මේ equity holders ලා දරා ගන්න additional risk එක වෙනුවෙන්. For the additional risk they are bearing exceed the bondholders return risk. So therefore bond yield plus risk premium method. Bond yield plus risk premium approach is based on the fundamental tenet in financial theory that the cost of capital of risky cash flow is higher than the less risky cash flows. Cost of capital riskier cash flows is higher than the less riskier cash. On this tenet, cost of capital for riskier cash flow is higher than the less risky cash flow. Now for the equity holders, risk of the cash flow is higher. It's higher than the debt holders. On that base, we calculate bond yield plus risk premium method. Here, actually, when we say the risk premium, this risk premium is not the same as the CAPM risk premium. දැන් අපි CAPM එකේ risk premium එකක් calculate කරානේ. CAPM එකේ risk premium එක කිව්වේ market return එක minus risk free rate into beta. That is the risk premium. Do you remember this? This is our formula. This is risk premium on the CAPM. This is the risk premium on the CAPM. But here this risk premium is not like the CAPM. CAPM risk premium simply market risk minus risk free rate. That is the risk premium. But here this risk premium reflect cost of equity minus cost of debt. That difference, cost of equity, the difference between the cost of equity and cost of debt, or the required rate of return in the debt capital and required rate of return in the equity capital. So therefore that two theoretical explanations are there for the risk premium in the CAPM and this bond yield plus risk premium method. අනේක මතක තියාගන්න මේ මෙතනදී අපි ගන්න risk premium එක නෙමෙයි මේ මෙතන risk premium එක කියලා කියන්නේ. මෙතන risk premium එක කියලා කියන්නේ debt capital එක exceed කරලා equity capital එකේ තියෙන ප්‍රමාණය. That is the risk premium. So equity capital cost minus debt capital cost. That is the risk premium. ඒතර ඒ තමයි equity holders ලට add වෙන risk premium එක. So that reflect here bond yield plus risk premium method. This method produces an approximate estimate of RS and can serve as a useful check. This is useful, actually the useful method and frequently used in the companies, investor analysts, where there is a publicly traded debt capital. So then using that debt cost, quickly they can add something for the equity risk premium and then they can calculate cost of equity. Now, if you go to the example, if you go to our question here, say here, this bullet for the for the over on bond yield plus risk judgmental risk premium approach, the firm uses 3.2% risk premium. It is given for their over on bond yield plus risk judgmental risk premium approach or bond yield plus risk premium method. The firm uses 3.2 risk premium. So based on the bond yield plus risk premium method, how much the cost of equity? 3.2 is the cost. 3.2 is the risk premium. So risk premium එක දීලා තියෙන්නේ. Don't worry about that one. So then what is the cost of equity based on this approach? Based on bond yield plus risk premium approach. Yes, 10.2, no? Is it 10.2? How this 10.2 come? Our cost of debt was how much here? Our cost of debt was 7%. 7%. Cost of debt was how much? So now you have to take the cost of debt capital. Abhi earlier calculate karane cost of debt capital here. It was 10%. No, how much it was? So bond deal here 10%. Yes, that is 10% of before tax basis, right? Before tax basis, right? I am using the before tax basis. So it was before tax 10%. So now bond deal plus risk premium method, for the bond deal plus risk premium method, company says the addition of the risk premium is 3.2%. So then how much the cost of equity based on the bond yield plus risk premium method? $13.2. It should be 13.2. We are using the bond yield before tax, right? Because here we are estimating the cost of equity. So we use here bond bond yield that is before tax adjusted. So here it was 10.2. I think you can remember that we done this calculation. It was 10.2. It was 10.2, right? Or approximately 10. Now risk premium is given. It is 3.2. So therefore, it is 13.2 is the bond yield plus risk premium method. According to that method, cost of equity is equal 13.2. Here, this is what we calculated earlier. අපි 10 හොයාගත්තා මතකද අපි අර මේ bond එකේ yield එක හොයාගත්ත rate function එකනේ, so that is 10%. So 10% plus this one, it is 3.2. මම මෙතන 4 mistake එක, right? It is a mistake. So then it is 3.2, 13.2. Right. So this is the bond yield plus risk premium method. So the next one is the dividend discount method. This one I think very familiar for you. Earlier in the security valuation, you use this DDM method, dividend discounting model approach. So in here, you assume that dividends are growing at a constant rate. When the dividends are growing at a constant rate, did you remember the formula or the dividend discount model that you apply to calculate the value when the dividends are growing at a constant rate? Remember this formula: next dividend divide by KE, cost of equity minus constant growth rate. We apply this to calculate the value. So same formula we are using here to estimate this one. This is cost of equity. So cost of equity is equal P value mean this is price. Value mean this is price. If the market is efficient, intrinsic value and market price are equal. So therefore, we can derive this formula on the DDM method. You can estimate cost of equity, next period dividend divide by price plus growth rate. Next period dividend divide by price or value plus growth rate. This is constant growth rate. Now, if you go to our question, there are some information given to this approach also. Common stock currently selling for 50 rupees per share. Last dividend was 4.19. Last dividend mean D0. D0, 4.19. Dividends are expected to grow at a constant rate at 5%. So they are expecting to grow the dividend at a constant rate of 5%. So you can apply dividend discount model because dividends are growing at a constant rate for the indefinite time for the near future. So issuing new common stocks incurs a flotation cost of 15% to the proceeds. So now you can adjust the flotation cost also using the DDM method. So we'll see. So we apply this information for the DDM method or dividend discounting method. So those are the information. D0. In the question, what it says? Its last dividend, you can see the, I think you can see the question. Its clearly say its last dividend was rupees 4.19 and dividends are expected to grow at a constant rate of 5%. This is last dividend. Last dividend just paid. After that, dividends are expected to grow at a constant rate of 5%. So it's not the dividend expected to pay. Somebody asked me that question. Instead of the last dividend question, use a dividend expected to pay. No, not dividend. This is not the dividend expected to pay. It's last dividend. This is paid. This is paid, already paid. But dividends are expected to grow at a constant rate of 5%. Okay. Are you okay? Somebody, I'm asking that question. I don't know why that. I can't see your name here. Are you okay with this question? One who asked this question? Are you okay? Instead of last dividend question, due dividend expect to grow for the so we need to adjustment for the growth rate. What are you asking that question? Actually, my question එක තියෙන මේ මෙතන නේද refer කරන්නේ. Can you talk with me? I can't trace my MBAD 2021. Okay. No. Yes. If the question say that this next period dividends like this, right? If question say now instead of the last dividend, if question say that next period dividend, say in this example, if it say its next period dividends is 4.19 and after that dividends are expected to grow like this, then no need to adjust. So then this is the D1, next period dividend. But here this is last dividend. This is last dividend. So then we have to take it as a D0. This is the D0 and then constant growth rate is given. So we can apply DDM method, right? So D0 is 4.19, P0 is the price 50, constant growth rate is 5%. So now you can apply the DDM method, dividend discounting model, to calculate the cost of equity without considering the flotation cost, right? So you have to work out the D1. If you know the D0, you can calculate D1 using this formula. Then D1 is equal 4.39 or approximately 4.4. Divide by price plus growth rate. So cost of equity is 13.8. Cost of equity is 13.8. 13.2 ne කොහොමද දන්නේ? 13.8, no? Did you get the 13.8? Have you got this number, 13.8? Okay, no? Right, so this is based on the DDM method. So now we apply the three methods: CAPM, bond yield plus risk premium method, and DDM method. So further explanations here related to the growth rate. If the growth rate is not given in the question, suppose the firm has historically earned 15% on equity. If you are not given the growth rate in the question, I think I in the risk and return also I explained this one, I remember. If you are not given the growth rate, you can apply this formula to estimate the growth rate. Growth rate is equal retention ratio, RR here, retention ratio into return on earnings or return on equity. Both are there, return on equity or return on earnings. So suppose the firm has historically earned 15% on equity. 15% on equity, retain 35% of earnings. 35% of earnings. An investor expects this situation to continue in the future. If constant retention ratio and constant payout is there, then you can apply this formula to estimate the constant growth rate. Earlier also I explained this. So therefore now if you know the retention ratio and also if you know the return on equity or return on equity or return on retained earnings, then you can apply this to calculate the growth rate. So here growth rate is equal 0.35 into 15%, 5.25. So this is very close to the one given in the previous example. It is also 5%. So likewise, using historical data in your research, if you are analyzing this kind of things, you can estimate growth rate using this formula. And also you can use this one also. No, this is the way how this one is derived, right? Simply I will explain very quickly how this formula is derived. Now here, earnings next year, simply if there is a constant growth in earnings, if there is a constant retention ratio of a company, earnings next year is equal earnings this year plus retained earnings this year into the return on retained earnings. I will insert some, then I will show you, right? Simply, right? Earnings next year, right? I will write here. Earnings T plus 1 next year equal earnings this year E0, say E, not E0, ET plus retained earnings this year, retained earnings year T into return on retained earnings, right? Return on earnings or return on retained earnings, right? If you divide both sides of this equation by earning this year, right? Both sides we are dividing by earning this year. So they are dividing here earning this year. This is also we dividing earning this year, right? Earning this year. Then this part, left side of this equation, substitute by 1 plus growth rate. How this come? Normally earnings growth is equal, right? Normally earnings growth is equal E T plus 1 minus ET P1 minus P0 divided by ET is equal earnings growth rate. This we can write like this, no? E T plus 1 divided by ET minus ET divided by ET equal to growth rate. The same one you can write this way also, no? Then ET to ET you can cut out each. Then here ET plus 1 divided by ET is equal G plus 1. So that way, here, ET plus 1 divided by ET is equal to 1 plus growth rate. Now here, in the basic formula, ET to ET, you can cut each. Then this is 1. Here, retained earnings this year divided by earnings this year into return on retained earnings. Same formula. So retained earnings this year mean this is retention ratio. This is retention ratio. ව්‍යාපාරයේ earnings වල රඳවා ගන්න ප්‍රමාණය retention ratio. So retention ratio into return on retained earnings plus 1. So this one to this one we can cut each other. When this one come to this side, it is minus 1. So then they each trade off each. Then growth rate is equal retention ratio into return on retained earnings. So this is how this formula is derived. So this you can apply to estimate the growth rate if there is a constant growth in dividends. If there is a constant growth in dividends and constant payout ratio. So this formula you can apply to calculate the growth rate. Right. So now can DDM methodology be applied if growth is not constant? Now company's growth is not constant. So then can DDM method apply? Yes, we can apply. Theoretically, it says that even non-constant growth stocks are expected to attain constant growth at same point, generally in 5 to 10 years in their life cycle. Normally, companies after 5 to 10 years, then අපි ගත්තොත් එහෙම කම්පැනි එක ලයිෆ් සයිකල් එක මේ විදිහට යනවනේ ගිහිල්ලා මැචුවර්ඩ් වෙලා මෙහෙම වෙලා ආයි ටර්න් අරවුන්ඩ් වෙනවා ඔය විදිහට. ඒතර so after 5-10 years they are reaching to the maturity, so therefore they are expected to growth dividend growth at a constant rate. So theoretically, therefore it says that DDM methodology even applied to the company where there are 5 to 10 years histories. For the companies that there are generally 5 to 10 years history. So that is the answer given in the theory. We can apply. So now if you compare the CAPM versus DDM, CAPM versus dividend discount model, in the CAPM explicitly adjust for risk, because you can see market risk based on the market risk, we explicitly adjust the risk. Applicable for companies that pay no dividends or whose dividends growth is difficult to estimate. So we can apply CAPM where we cannot identify the dividend information, where constant dividend is not there. So we can apply CAPM. If it is difficult to estimate the dividend, so you can go with the CAPM. But when it's come to the DDM method, right? When you come to the DDM method, this is simple. Right, this is simple, but this is only applicable to firms that pay steady dividends or the constant dividends. So you can't apply to the companies that there is no constant dividend. But anyway, in theory, it says that after the 5-10 years, you can apply for the companies with the history in their life cycle after 5 to 10 years, then you can apply the DDM method. So this bit small comparison between that CAPM and the DDM. Now, simply, what is the reasonable final estimate for the cost of equity, cost of internal equity? CAPM was 14.2, DDM was 13.8. Now here, I think this is bond yield plus risk premium was how much? 13.2, no? Yes, it is 13.2. So approximately an average estimation you can get. This is 13.2. This is 13.2. So you can get the average of this. So how much here? Reasonable final estimate of RS. How much? 14.2. කියදෙන්නේ. Reasonable estimation is
13.7 million.
13.7. So approximately you can now in this example like this, you can estimate using different methods. Now in this example, you are given information to apply the CAPM. You are given information relevant to apply the DDM, and also you are given information to apply the bond yield plus risk premium. So from using all methods, you can estimate these numbers, and then you can get the average of that. So approximately 13.8 is the reasonable final estimate for the cost of equity, internal equity. Right. So now we'll have a few minutes break around now it is 11:07. Yes, 11:07 after 11. Yes. So around 11:20 we will meet again after the 2 minutes break, right? Okay, are you agree?
Yes, madam. Thank you.
Okay, 11:20, right? Hurry. Shall we start? Shall we start? Okay, no? Right. Okay. So, so I think you can see the slide now. So now we estimate the cost of internal equity using CAPM, DDM, and bond yield plus risk premium method. Now, why the cost of retained earnings is cheaper than cost of issuing new common stock? The reason is that is flotation cost. Because when company issue new common stock, they have to pay flotation cost, or we call issue cost, to the underwriters for certain documentations, legal charges are there, stamp duties are there. So certain types of flotation cost or the issue cost are there for the underwriters. When company raises new capital, it generally seeks the assistance of investment bankers like underwriters, like investment bankers. They charge the company a fee based on the size and type of offering. So this fee we call flotation cost. So normally this flotation cost present as a percentage. So depends on the firm's risk and the type of capital they are being issued. Yes, for the new issue of the preferred stock also flotation cost is there, but in the preferred stock cost estimation, this flotation cost in most theories, they ignore that. It's not much large value, but in case of the equity capital, the risk is high. But in the flotation cost, this flotation, but in the preference shares, the risk is comparatively for the ordinary shares. In equity stock issue, the risk is high. So therefore, some textbooks, even in the preferred stock dividend issuance, this flotation cost is there. Underwriters help for their issuance in the assessment in documentation. But anyway, that is in practice, we are not considering that. But anyway, if in the question it says that should consider, then we can adjust the flotation cost for the price. But in the common stock, we can adjust this flotation cost when there is a new stock issue. This cost depends on the risk and the type of the capital being issued. Flotation cost are highest for common equity. That's what I told. Normally, flotation cost is high for the common shareholders, but common stock. But for the preferred stock or the preference shares, comparatively very small number, small percentage. So therefore, it is sometimes you can ignore. Anyway, if it is considered, you can adjust it for the price. You can adjust it for the price. However, since most firms issue equity infrequently, the per project cost is fairly small. We will frequently ignore the flotation cost when calculating the weighted average cost of capital. So normally, when we estimate the weighted average cost of capital, frequently our practice is to ignore the flotation cost. But if it is considered, we can use the DDM method. We can use the DDM method to adjust the flotation cost. So here you can see for the price, we adjusted for the flotation cost. This is the flotation cost as a percentage of the issue price. F is the flotation cost. This is D1 into 1 plus growth rate is the D0 into 1 plus growth rate is the D1. P0 is the price. G is the constant growth rate. So flotation cost you can adjust using the DDM method. So now in our example, it says that issuing new common stock incurs a flotation cost of 15% of the proceed. So if we are considering this one, so you have to go with the DDM method and you can adjust this for the price and you can calculate the new stock, cost related to the new common stock like this way. It will be 15.4%. So by adjusting the flotation cost. It is 5% no? No, it is 15%, right? 15%. So we are adjusting this for the price. 15 to 1 minus 15%. So you will get this value. So now we can estimate overall cost of capital for the alpha. We can estimate overall cost of capital for the alpha because we know cost of debt, cost of equity, cost of preferred stock for the alpha. But anyway, you should know the weights. In the question it says, you can see firm's tax rate is 40% and target capital structure is 30% long-term debt, 10% preferred stock, 60% common equity. So they are given the target capital structure. So then you can now estimate back or the overall cost of capital. So we know each of the variables. So now we can calculate. So weight on the debt capital is 30%. So 30 into after tax cost of debt. So before tax it was 10%. So we are adjusting it for the tax. So that is after tax cost of debt. Then cost of preference share cost of capital. Then its weight is 10% and cost of equity. This should be the 13.2, I think. According to your number, you can take that because it was a mistake. This is 13.8. So then this is 13.8. So you can calculate overall cost of capital is 11.1. This is the weighted average cost of capital. What factors influence the company's survey? Now you okay? I think you can get this number very easily. This is weighted average cost of capital. So what factors influence the company composite weighted average cost of capital? Market condition, dividend policy, firm's capital structure, their investment policy, and the risk of the projects will influence on the weighted average cost of capital. Firms with the risky projects generally have a higher weighted average cost of capital. So actually, should the company use the composite weighted average cost of capital as the hurdle rate for each of its project? Here, this weighted average cost of capital have calculated using internal equity, right? Internal equity. This is this was 13.8. No, not considered the new cost, new or the external cost of equity, because if there is a retained earnings, first we finance using the retained earnings. After that, we are issuing the new common equity. So therefore, first we estimate, when we estimate the weighted average cost of capital, we are considering the internal equity. Now in our example, it was 13.8. But when more and more capital is required, the company has to do new issue. We call that breakpoints. In the capital structure, capital market line, breakpoints can arise. So when the breakpoints are coming, so you have to change the cost of each component. So likewise, you have to estimate the cost of capital. Initially, I have considered here internal equity. So the one of the questions, should the company use the composite WACC or the overall cost of capital as the hurdle rate for each of its projects. Now this number, this cost of capital or this WACC we are using in our next topic, that is to evaluate the project. Now question is, are we using this same number for all projects? We can't do that. This is actually the basic fundamental things related to the cost of capital. You have a lot of things learned beyond this breakpoint calculation, and so likewise certain things are there, a lot of knowledge are there, but here just very basic things. Now when the projects are with the different degrees of risk, when projects are with different degrees of risk, can we use this overall cost of capital as the hurdle rate or as the benchmark? No. If the project risk is differed from the company average risk level, then this project cost of capital, we have to adjust it for the risk. Or the company cost of capital, we have adjusted for the projected project cost of capital. This is another area that we have to discuss. Once we calculate this back, we can't use this for the all investment analysis, all investment project analysis, because projects are having different degrees of risk. They are having different degrees of risk. So if this particular project risk is very high to the average risk level of the company, then we have to be very careful when we evaluate in this project using the company cost of capital. That is wrong. This company cost of capital, you have to adjust for the risk. The composite weighted average cost of capital reflects risk of an average project undertaken by the firm. Now, when we say the firm is a collection of the project. Firm company is a different projects are there, is a collection of the projects. So here this firm cost of capital, or the number that we calculated here, reflects the average cost, average project undertaken by the firm. So it reflects the risk of an average project. Therefore, weighted average cost of capital only represent hurdle rate for typical project with the average risk. We can use this weighted average cost of capital or this cost of capital or this marginal cost of capital to evaluate a typical project with the average risk. But if the projects have different risk, if it is different from the average risk, then you have to adjust this for the project risk. So this is another area that we have to discuss. Actually, I am not going to discuss that deeply, but anyway, you have to remember this. In future, there are a lot of areas to discuss. Breakpoints we didn't discuss. Once this cost of capital is changing, when component cost of capital is changing. So therefore, there arise the break point. Cost of capital like break points ඇති වෙනවා. මේ cost of debt එක වෙනස් වෙන ගමන් මෙතන break point එකක් එනවා. Marginal cost of capital එක වෙනස් වෙනවා. So likewise, you should able to calculate the break points in the cost of capital, but we didn't discuss this thing. But anyway, there are a lot of things to discuss beyond this. And also here, this project risk adjustment, right? Certain areas that need to further discuss. So adjusting the weighted average cost of capital for risk, simply I will explain this, but this is not much deep discussion. If a firm has project that is much riskier than its typical project, will it make sense to use its overall cost of capital to discount project specific cash flow that don't have same risk as the company's average cash flow? If a project has which much riskier than its typical project, can we use this cost of capital or this average cost of capital to evaluate this project? We can't. The answer is can't. We have to adjust this cost of capital for the risk. Now let's see this example. Consider a shop with two divisions, A and B, right? Division A riskier and has cost of capital, say 14%. Division B, cost of capital 10%. Each division approximately same size. The weight for each equal. So company overall cost of capital, then therefore 50 on 14%, 50 on 10%. So overall it is 12%. This is the average for the average risk, company cost of capital. The division A manager has a project with 11% expected rate of return. Now division A manager has a project with the 11% expected rate of return. Division B manager has a project with the 13% expected rate of return. Should these projects accepted or rejected? Now, if you consider company overall cost of capital, it is 12%. So, if you look at the division A, it has a project with the expected rate of return 11%. But the overall cost of capital of the company is 12%. A division, if you consider the division A, its cost of capital is 12%. Either considering this one or the overall cost of capital, you can't accept this project. Why? Its rate of return less than the cost of capital. So this is not feasible. This is not feasible. So you have to compare this with actually this one. When you compare it, because now the risk levels are very different. No? Average is 12%, but when you consider division A, its cost of capital is 14%. Either you consider this one or the overall one, this is rejected. But when we look at the B, division B, it has project with 13% expected return. What happened? Both are rejected, no? But anyway, but if you consider B, its cost of capital is 10%. There is a project with the required rate of, or the expected rate of return is 13%. Now here, division B manager can accept the project. But anyway, that project should be accepted. No, division A manager cannot accept the project because its risk level is very high. But once we consider the division B manager's project, if you consider the overall cost of capital, even you can accept this because overall cost of capital is 12%. But the project is required rate of return is greater than this. And also beta or the division B cost of capital is very low. Its risk is very low. So therefore you can accept the B. So likewise, what the message I want to highlight here, project expected rate of return, you have to compare with the project cost of capital if the risk is very different from the average risk level of the company. Company के average risk නැත්නම් typical project එකක risk එකකට වඩා අපි consider කරන project එක project එකේ risk එක වෙනස් නම් වැඩි නම් different නම් overall cost of capital එක අපිට ඒ project එක evaluate කරන්න ගන්න බෑ. So you have to adjust this overall cost of capital for this particular project risk. That you have to consider. So for that there are certain mechanisms, certain approaches. So we have to consider that one. Always this overall cost of capital is not the only the one number or the only the one hurdle rate to evaluate all the investment. But remember that when the project risks are different, then you have to consider that point. Now let's see like this. Now there is just in the weighted average cost of capital for risk. This is very small example. Iron steel company has only one division and uses only equity capital with beta 1.1, risk-free rate 7%, market risk premium 6%. Assume company creates two new divisions, transportation and distribution, with betas 1.5, 0.5. Two divisions with the betas of 1.5 and 0.5 respectively. If 70% of company value ends up in the steel, 70% of the company value ends up in the steel division, 20% in transportation division, and 10% in the distribution division. So these are the weights. There is a portfolio. So the weight 70% on the steel division and 20% on the transportation and 10% on the distribution. So investors require rate of return for the steel division, transportation division, distribution center, and for company. So now you can see their betas are very different. For the steel corporation or the steel company, 1.1. They have two divisions now they have created. Betas are different. For the distribution, transportation, 1.5. For distribution, 0.5. So you have to estimate the required rate of return for the steel division and transportation division, distribution center, and for overall company. So if you are estimating the required rate of return for the steel division, you have to consider this beta. When you estimate the required rate of return for the transportation, you have to consider the 1.5 beta. And also for the distribution, beta is 0.5. So likewise, you can calculate. We are applying CAPM here because the given data relevant for the CAPM. So therefore, we are applying CAPM. So steel division, risk-free rate plus market return into the beta. Market return is 6%. So into beta 1.1, 13.6. Transportation division, beta is 1.5. So therefore, 16%. See the different required rate of returns are there. Distribution center, required rate of return is 10%. For company beta, you can calculate company beta using the weighted average beta. So the company beta or the overall beta is here, beta company is equal 70% into 1.1 plus 20% into 1.5 weighted average beta plus 0.5 into 10%. So this will give you the overall beta of the company 1.12. Overall company beta is 1.12. So based on this overall beta, you can calculate required rate of return for the company is 13.27. So likewise, you can see different rates of returns are there for the different divisions because their risk levels are different. So therefore, when we evaluate in the investment using the cost of capital, if the project risks are different, then you can't use overall company cost of capital. You have to adjust it for that risk level, considering the beta of each company, or there are like methods. So now here, this is just application of how to apply that. So this is the end of the cost of capital topic. So if you go to and relook what we discuss here, we start with some overview of the cost of capital, and you learn what is the meaning and what is the importance of this number. And then we discuss weighted average overall cost of capital and how to compute each component cost of capital for the cost of debt, cost of preferred stock, and then cost of equity using different methods. And finally, we discuss and we concluded that company cost of capital is not always the good number to evaluate the project, especially when the project cost of capital is different. So then we have to adjust that. If risk level is differed for the projects, then we have to adjust it for the risk. Some of you are asking question, how this 13.8? This is 13.8 means which one? 13.7. 13.27 is using the company beta. Here for company required rate of return, first you have to work out this one. Beta for the overall company is 1.12. This is the beta for the steel division, beta for the transportation division, beta for the distribution. So the beta for the overall company 1.12. This is weighted average. 70% from the steel, 20% from the transportation, 10% from the distribution. Then this company beta you have to use here. 13.72. This is 72. It's okay. That might be the mistake. 13.72. Okay. So this is end of the cost of capital. Anyway, I have included some questions for you to do as a self-study. All these things you can do now, right? I have went through. So later, as the homework, to practice the things, please do all these things. And if you have any questions or any clarifications, you can ask once you attempted to do this, right? Without attempting, you can't ask the question. But anyway, all the things you can do. Because based on the discussion, all these things are in the level that you can do. Right. So this is the end of the cost of capital. If you have any questions or anything for clarification, you can ask. Otherwise, I am moving to the next one, that is capital budgeting.
Madam,
Yes.
small question, madam. So I'm not from a commerce background. So
Yes.
therefore, most of the concepts are really new and ambiguous to me, as well as some of the colleagues in the same batch.
Okay.
So in the examination, madam, are you going to test each and every concept which were taught by you?
Each and every concept, we now let's see the risk and return. In the risk and return, you learn what is return, what is risk, how to estimate risk for the single asset, for the portfolio. So likewise, you came in a flow. But I'm not checking all the things. But anyway, once at the concluded, you should know, you should be able to calculate or determine the expected return and risk of a portfolio. And also you should be able to identify whether this portfolio get some advantage from the risk diversification or not. So that you, at least you should be able to at that level on that discussion that is related to the risk and return. Are you clear that?
Yes, madam.
Are you clear? Now, I am not asking each of the every concept or every question, but anyway, in overall, you should be able to that point. You should be able to calculate portfolio expected return, portfolio risk, and you should be able to conclude whether this portfolio has get risk advantage or not. I explained it and I teach you how to determine that. So at least that one. Apart from that, certain conceptual questions will last. Now, if you go to the cost of capital, now let's see this question. Now here I will go through this second question. Shy Importers balance sheet shows $300 million in debt, $50 million in preferred stock, $250 million total common equity. Shy tax rate is 40%. RD is the cost of debt is 6%. Cost of preferred stock is 5.28. Cost of equity 12%. If Shy has target capital structure, 30% debt, 5% preferred stock, and 65% common stock. What is the weighted average cost of capital? Now, on this discussion, at the end, you should be able to do this. Now, how many of you just look at yourself and see whether you have a confidence to do this kind of thing? Because based on the discussion, you should have get that knowledge. Because based on my discussion now. Are you in that confident level?
Yes, madam, that can be managed.
Yeah. So now when you are managing this one, there is a tricky thing. Now we are given here balance sheet values, book values, as well as target weights. So when you calculate the weighted average cost of capital here, you have to base on the target capital structure. If you calculate the weights based on the book value, that is wrong. Are you clear? Now,
Thank you so much,
I
madam.
think these questions are very simple, and also you better to go through the past 2-3 years questions. Apart from that, you will get formula sheet and the equations. If you know the concepts and the things, if you comprehensively I understood the things that we discussed, I think nothing to worry. Nothing to worry. That's much not difficult, the paper.
Okay, madam. Thank you so much.
Okay. So shall we move into the our next topic, that is capital budgeting. Right. So we have to start the capital budgeting. This is my last topic. Now, you know how to calculate cost of capital. This cost of capital is very important when you evaluate the long-term investment. Without knowing this company overall cost of capital, how finance manager evaluate? How calculate the net present value? No way to calculate. No way to take decision based on the internal rate of return or the IRR. So now here we are going to apply this cost of capital to evaluate long-term investment project. Simply what we are going to do here. So as a learning objectives, you will learn some terms related to the capital budgeting. What is capital budgeting? What is the terminal cash flow, incremental cash flow, initial cash flow? Some vocabularies are there. So you will learn these names and basically, and also our priority are on this area. Different evaluation techniques. We are discussing these different evaluation techniques. So we are based on mostly on this area. In the capital budgeting process, there are certain steps. There are certain steps you have to follow, but our more weight or our more focus on these different techniques. And then we discuss just when there is unequal lifetimes of the projects, how to estimate the NPV, and also economic life and the true life. So these things we discuss. So those are the things actually I'm going to cover under this capital budgeting. So first of all, what is capital budgeting? What is capital budgeting? Is the decision-making process that companies use to evaluate potential long-term investment project. Long-term. So when we say the long-term, the expected return of this particular investment to be received in more than 1 year, maybe during 5 years, 10 years, 15 years, so likewise a long term. Now, if you invest in the stock, inventory, current stock, so that is a short term investment. අපි බඩු තොගයක් ගත්තොත් අපි inventory එකක invest කරොත් this is a short term investment because the return on this stock you will get within a year. It's a short term. But here when we say the capital budgeting, we consider long-term investment project. Long-term investment project. So what is the specialty in the long-term investment project? The return you will get in long run. අවුරුදු 10ක් 15ක් 20ක් තුල මේ ආයෝජනයේ ප්‍රතිලාභ ලැබෙනවා. So it is the long run. That is more than 1 year. So long-term decisions involve large expenditure. This is not like a current investment in the current assets. This involves large expenditure. It's a large cash flow. Very important to the firm's future because this is directly impacted to the growth of the company. This incurred large amount of funds, 1 billion, 2 billion, so likewise large amount of investment. Their returns are expected to in 2 years, 20 years, 30 years, so likewise in the long run. And also this directly affected the growth and also the value of the company. Once you take these decisions, it is irreversible. You can't reject it. You can't withdraw it. It's not reversible. Right? You can reversible, but it's include large amount of sunk cost. You can't recover it. So therefore, when you are taking this long-term investment decisions or the capital budgeting decisions, You have to do that after careful, very serious analysis, because this is not reversible. It's affected to the risk, it's affected to the growth rate of the company, it's affected to the value of the company. Ultimately, company can bankrupt if you take the wrong decision. You will bankrupt distress, and you will bankrupt if you take the wrong long-term decisions. So likewise, this is very important decisions that financial manager is responsible. Long-term investment decision, dikukalina ayojana tirana. ඒතකොට දිගු කාලීන ආයෝජන තීරණයක් කියන්නේ මේ රුපියල් 1000 ආයෝජනය කරනවා වගේ නේ මිලියන ට්‍රිලියන ගානක ඉන්වෙස්ට්මන්ට් එක. ඒතර ඒකේ රිටර්න් එක දිගු කාලයක් තුල ලැබෙන්නේ. එතකොට ඒ වගේ ඉන්වෙස්ට්මන්ට් එක you can't take overnight. අද හිතලා හෙට ගන්න බෑ. It includes process. It includes process. So you have to go with that process. You have to identify the feasible projects. You have to evaluate them. You have to present them to the board of directors. You have to get the approval. You have to estimate their cash flows. You have to estimate their risks. And then you have to identify the cost of capital of the project. Then you have to calculate NPV, IRR, payback period, profitability index of the project, and then you can compare it with the other alternative projects, and then you can take the decision. Prior to the decisions, again, you have to look at the process. This process will take more than three months, 6 months, sometimes 1 year's time to finalize the decision. So likewise, this is what a long-term investment decision. Very important to the firm's future. Why? It's involved large amount of expenditure, cash flow. It's affect directly to the risk of the company, growth of the company. So therefore, that is affected to the future. So what are the such investment? You can see different classifications are there. Expansion project. Now, the currently company is producing, say garments. So they are expanding their investment to the hotels. So another unrelated area, another industry, expansion is a investment decision. So if you are going to the hotel industry, so they have to carefully analyze this project. Expansion, say expansion like they have currently 1 factory. So they are expansion into the 2 factories. Their premises in the business, they are expanding. So likewise, it's an investment decision. And also diversification. Diversification also kind of expansion, but diversification means they are diversifying to the different field. You know what is the reason of diversification? Project in the portfolio, we learned that diversification to minimize the risk, to mitigate the risk, to manage the risk. So we are diversifying to the related industries. For the unrelated industries, maybe horizontal diversification, maybe vertical diversification. Horizontal mean we are acquiring our suppliers. Vertical, likewise, if you are going to the forward diversification, we acquiring our customers. So likewise, if you go to the web and Google, and if you search what is diversification, you can see certain degrees of diversification. අපේ suppliers ලව acquire කරගන්නවා, අපේ customers ලව acquire කරගන්නවා, එහෙම නැත්නම් අපි different industry එකකට diversify වෙනවා, related industry එකට යනවා. So likewise, this is all the diversifications coming under the investment project. They are long-term investment. Replacement. Say currently all the production are going through the labor, based on the labor. It's a labor intensive one. This labor intensive production process, now we are going to replace with the capital. You are replacing machines, computers, other equipments, other things, and likewise, all the things we are replacing with the machines. So that is a capital intensive. Employees la wayin karala, vadipura machines dala. So that is a process of replacement. The existing labor intensive projects you are replacing to the capital intensive. Modernization. Say previously it is very lethargic environment. Now you are modernized with the AC, lobby areas, attractive things, moderations, likewise. So certain things we can do for the business environment. මිනිස්සුන් ආකර්ෂණය වෙන විදිහට ඉන්න waiting areas, එතකොට නිකන් relaxation tank එකක් හදලා music එකක් දානවා. So likewise modernization. All these things we are doing with the future expected return. Now if you look at the Kiel Super, like Supermarkets, they are investing lot for the parking. They invest lot for the parking areas. It's an investment. For this investment, they expect certain increase of the turnover, certain attraction of the customers. On that way, they are expecting to some returns in the for long term, maybe 20, 15 years. Their outlet is very small, but the parking is very large. And all the things are investment decisions. They are expecting future returns. This is one classification. And also you can classify it as a mutual exclusive investment, independent investment, contingent or the dependent projects. So you can see here some example for this long-term investment: expand the existing product line, lease in, mergers and acquisition, enter a new line of business, replacement, advertising, R&D, research and development, education and training. So companies providing you the education, training, foreign training, all are investment. Advertising. So how much of money you are investing for the advertisements? So that is an investment. You expect return. You expect some return. So you have to evaluate them. So this is very carefully. You have to evaluate. What is this mutually exclusive project and independent and dependent? Mutually exclusive mean they are for the same purpose. You are evaluating two projects, but for the same purpose. So therefore, if the cash flow of one can be adversely impacted by the acceptance of the other, we call it as a mutually exclusive project. They are for the same purpose. When you accept A, automatically B is rejected. So assume that you are evaluating to purchase a large photocopy machine. You have selected two brands, A and B. So when you evaluating these two brands, after all this evaluation process, once you select the A, automatically B is rejected because they are for the same purpose. They are for the same purpose. So then what is independent? They are for the different purpose. Now assume Toyota company want to increase their vehicle production, say 30% by the light vehicles productions and say 70% by the heavy vehicle production. So they are independent. 30% 70% production targets they are independent projects. They are not affecting each other. So they are for the different purpose. If the cash flows of one are unaffected by the acceptance of the other, we call independent. So you can see the difference between independent and mutually exclusive. So what is this contingent? What is this contingent? Contingent means that is we call dependent project. Acceptance of one project is dependent upon the selection of another. This is very good example. Assume that the company is going to establish, say, a factory in a very remote area, in a village area or a remote area where there are no certain facilities. So now this is they have selected this place for establishing a factory. So before that, with that main project, there are certain projects they have to do. They have to provide, they have to develop infrastructure, telecommunications, water, accommodations, and sanitary facilities. So likewise, there are certain projects are linked with this main project. So this is what we call contingent. So the acceptance of one project is dependent upon the selection of another, dependent. So if we select that main project, all these small projects we have to complete. This is we call contingent type project. So there are another classification of the project that we can classify it as mutually exclusive, independent, and contingent. So remember that in this capital budgeting also, I am going with the very basic thing. So when we say the capital budgeting, it's like very huge area. It's like what we call Sagarayak wage danuma. But anyway, we are learning here very small thing, very small concepts related to the capital budgeting. So you are learning very few things related to that. So when we say the capital budgeting is a very big, huge area in the finance. So therefore, we are touching this simply. What are these concepts and like this. So we are going to evaluate independent and mutually exclusive project, but we are not much worried about this contingent and other types of project. So anyway, we discuss only the conventional type project, right? You will learn later what is this conventional type. There are certain projects, they are not traditional, they are not conventional. So when evaluating the non-conventional project, it is very difficult. It's very difficult. You have to consider real option, you have to consider inflation, other climate changes. So likewise, certain difficulties are there. We are not considering these things. Our focus only on the conventional type project. Right. So then steps in capital budgeting. So you can see, as I told at the beginning also, capital budgeting is a process of acquiring long-term investment. If you go to the definition here, you can see, I think capital budgeting is the decision-making process that companies use to evaluate potential long-term investment projects. It's a process. So this process involves certain steps. I have summarized them into 4. Estimate cash flows, inflow, outflows, and net cash flows. So when we say the cash flows, there is initial cash flow, incremental cash flow, and terminal cash flows. Then you have to assess the risk. So you have to calculate, you have to identify the risk level of this project. Based on this risk level, you have to estimate the applicable relevant cost of capital for the project. Are we using the overall cost of capital, or are we using the adjusted cost of capital? So we have to think about that. Then we have to forecast cash flow, risk of cash flows, and we have to forecast cash flow. Then based on the forecasted cash flow, you have to evaluate the project. Our main focus on this evaluation. But anyway, estimating cash flow also I have explained to a certain level, but our main focus on this evaluate of the cash flows. So we are calculating NPV, IRR, payback period, profitability index, and we see how we determine to accept a project or reject the project. So those are the things that we are going to discuss beyond this point. Yes, actually, I will, yes, I didn't give the PowerPoint for you. Anyway, I think I will share the PowerPoint with you. I will give to the your MBA unit. So